Welcome everybody to the Dis and Dat Market Update presented by Diversified Investment Strategies. Today myself, Shane Haig, my partner James Pope and Reggie McFadden are with us, and we're going to go through what was last week's newsletter in a little bit more detail, and at the end today we're going to also invite you to our next event. To get us started, we've got Reggie going through some numbers.
So this is the review of the asset class performance through 9/30 of 2014. Not going to go through each one. You can find the numbers in the recent Dis and Dat, but just wanted to show a quick view of how diversification actually works. While S&P's up around 8, you can see the smaller cap companies are negative along with international and commodities. Gold basically flat and Exxon down 5%.
Of course, next year we might see the flip-flop of that.
So this is a chart of ExxonMobil for 2014 through 9/30. You can see started around 100, ended at 94. This is not including dividends, but you can see the fluctuation throughout the year. So then we'll take a look at the top-down approach, kind of the fundamental analysis of the investment world. While not much has changed from a year ago, you can see basically the bond yields remain low along with inflation.
And now we'll take you through our news items. And really, this is our segment, This Too Shall Pass, which tries to focus us from the short term into the long term. And as we know, there's a drone invasion. Amazon and companies like that want to take drones and deliver goods to the consumers. One of their problems will be this little video we show where a hawk takes down a drone. So they do have some problems to work through. Next, we want to talk about robots taking over the world. And as you can see, some in this industry have gone to robots delivering investment advice. Our belief is that somewhere in the future, robots will not take over the world, but humans will use robots as tools. So next, Bond King Bill Gross, who manages the PIMCO Total Return Fund, has left the building. He's went to another bond fund. And so what this demonstrates is that even though we'd like to have a relationship with somebody that lasts forever, sometimes things just change in this world. And again, with this crazy market, we wanted to give you a chart to show how volatile the indexes can be throughout a year. Reggie's going to go ahead and take 1 year, but this demonstrates in the gray lines where the return actually ended for the year, and then down at the bottom are red marks demonstrating how far down during the year the index fell. This index happens to be the S&P 500.
Yeah, you can just see 2009 is interesting to point because through intra-year from peak to trough, it was actually down 28% at one point, ended with a positive 23%.
Enough to make you sick if you watch this every day. So as the calendar month folded over, we see much wider swings. CNBC actually put up this chart, which we copied for this presentation. And you can see the fluctuation in the Dows, just demonstrating what has gone on since the end of the quarter. This takes us back to another period. We, behind the scenes, grabbed this photo from Forbes in 2008, showing late October, early November, and the distressed, crazy floor traders, the anguish on their face, as that period was even worse than what we're looking at now, but it did pass. And so we often talk about our clients preparing for a hurricane before it strikes. Shane's going to run us through that process and how we do that here at DIS.
Great. Looking at the current target investment objectives allocation, many of the clients are used to this. Some of you haven't seen it. It's one way that we break things down so that you can customize the portfolio for yourself. That anguish you saw on daily traders is a little bit different when you're a long-term investor. And when we say that, we're talking about eligible investment strategies. You might have a certain percentage dedicated to that in this area over here, but you also may have the next 4, 6, 8, 10 years worth of expected withdrawals in money market, CDs, treasuries, or fixed term. And however you set that up for yourself, it's a kind of a reminder that you don't have to worry necessarily every single day about the investments because you don't have 100% in there. Yes, it's important, but what you're trying to do is plan ahead for that hurricane, knowing well in advance sometime in the next 10 or 20 years you're going to need that. Of course, we list down here, do you want to make any changes to that allocation, underscoring the importance and flexibility that we have with you to make changes as your situation changes or the economy changes. And very important to put all that together and monitor that frequently. A hypothetical example of that, when you break down the numbers from just that rough percentage outline you see, an individual could have a percentage earmarked in money market, short-term, mid-term, and then the investments, underscoring again in real terms, everything's not just in investments that are fluctuating when that market you see every day, you're reminded of those prices, but you also have many hundreds of thousands of dollars in many cases in other instruments not affected in the same manner.
Right, so that's a great example of part of our process. But we want to thank you for your time and also invite you to our Bayou Side chat. This is going to be an interactive mid-quarter update Thursday, November 20th at 1 o'clock. And we invite you to submit your questions for our interactive Q&A session to reggie@disria.com. If you're not a client, you can go to our website, www.disria.com, sign up for a free newsletter or a consultation, and we'll have your information. For those of you who are a client, we're going to send out an email invitation. So just watch your inbox, and we'll talk to you through there. And once again, we thank you for your time in viewing this. Have a good day.